Good afternoon. You're watching Business World Live. I'm Jes Delos Santos. Let's take a look at how the local bourse closed today, Wednesday. Okay, after that huge tumble on Tuesday, following that outlook downgrade from Fitch ratings, local shares today staged a recovery. The main index benefited from another last-minute bargain hunting, pushing stocks higher by 0.6% to 6,835. Now, one thing here that you have to take note of is that shares were down at least during the latter part of the session, something that Claire Alviar of stocks expected. This is many investors would rather wait for the market to establish a strong support area. She adds traders are also keeping an eye for the next quarantine guidelines. The palace did say that recommendations have already been prepared and that they're just waiting for possible appeals from local executives. Something to take into account. You have the health department noting an uptick in infections in 7 cities in NCR. What's clear for now, though, is that the travel ban in India and 6 other Asian and Middle Eastern countries stays until July 31st in the hopes of keeping out the contagious Delta variant. Question now is, will there be a similar ban in Indonesia, which is currently battling a surge due to the said variant? Well, Malacanang said that there's already a recommendation for that ban on Indonesia, but the president has yet to make a decision on that one. Now, back to the equity space, let's have a check at our leaders and laggards. LT Group on its 6th day of declines, performing the worst in the main counter, once again declining today by 3.9% after that 6% slump yesterday. Quite a number of big losers as well. You have Robinson's Land down by close to 2%. Bloomberry also edging lower by 2.8%. Same thing with Robinson's Land, also lower by 3.5%. Now on the upside, you have Emperador leading the day's winners, jumping 3.5%. Now among sectors, banks joined the rally here in the main index, despite reports from Fitch Ratings saying that local lenders are facing profitability headwinds and higher non-performing loans ratio as recovery remains low. But again, looking at our individual banks here, the three big giants led the counter with Metro Bank climbing 1.9%. BPI also up close to 1.5%, and BDO also ending the day in the green. Now, lastly, let's have a quick update on Philinvest REIT Corporation. Well, it's looking at a price point of 6 pesos and 70 centavos a share to 7 pesos and 30 centavos per share for its REIT IPO. That's according at least to term deals seen by Bloomberg. The ceiling of that range would yield 11.9 billion pesos with 1.6 billion shares on offer. The company had also set a maximum offer cap of 8 pesos and 30 centavos a piece. Books are set to close on July 19, with trading set to begin August 12th. As markets continue to weigh in on that outlook downgrade from Fitch Ratings, let's get more insights on that report from Fitch Ratings Asia Pacific Sovereign Team Associate Director Sagarika Chandra. We speak to her straight from Hong Kong. Good afternoon, Sagarika.
Good afternoon.
Okay, first things first, how likely is a credit rating downgrade here for the Philippines, especially considering that government won't at least likely expand revenue base anytime soon?
So under our baseline assumptions for the Philippines fiscal trajectory, when we're looking at revenues and debt, we are looking at central government revenues stabilizing somewhere at about 15% of GDP. And under our baseline, the general government debt to GDP peaks in 2023, and it slowly starts to decline. So as of now, under our baseline assumptions, we are sort of seeing a stabilization of the revenue ratios. However, the reason for the negative outlook is that we're seeing a lot of risks to the downside when it comes to the government's ability to consolidate its fiscals and to keep the debt on a downward trajectory, which is our baseline. So if you're asking the question, what are some of the factors that we will be considering and that could lead to a further negative rating action, it will really come from what our negative rating drivers are at this point in time, which is if we find that the debt to GDP ratio continues to go up, that could be a reason for negative rating action. And also the weaker medium term macroeconomic prospects combined with declining policy credibility, which could lead to us removing the current plus one uplift that we give from the SRM score. That's another factor that could lead to negative rating action. And also on the external front, if we find a deterioration in external indicators. So essentially, this is what we're focusing on when we're thinking of, say, taking a further negative rating action on the Philippines.
Okay, so what time frame are we looking at least for that review? 18 to 24 months, or are you at least looking at a shorter time period given the pandemic?
So our outlooks are typically somewhere between 18 to 24 months. However, having said that, the ratings are constantly being monitored as new information comes in. So we can always take a rating action, whether it's positive or negative, even within that time frame horizon. So it's really something which is an ongoing process, the reviewing of the rating level, but the outlook typically stays on for about 18 to 24 months.
But should at least debt levels fail to at least stabilize here for the Philippines, how soon or how soon is a possible credit rating downgrade going to happen for the country?
So as I said, if we find that the debt to GDP ratio continues to go up in the Philippines, our current baseline is that the debt will peak in 2023, but it is going to start gradually coming down. However, the downside risk, that's why we have the negative outlook. So if we find that the debt to GDP continues to keep rising, then that's coming from, say, a departure from prudent macro policies or any reversal of reforms, and that's also combined with sustained higher fiscal deficits, then we could think of a negative rating action.
Now, why are there no other at least outlook revisions in the region in Southeast Asia, considering that you also have a number of economies also struggling?
So a couple of things on that. In terms of the impact of the pandemic on the Philippines, we do think that its growth shock, the growth impact has been quite a bit higher than what we've seen in a lot of other countries. The contraction in GDP last year was 9.6%. We haven't seen that kind of contraction in other economies in the region. Also, in terms of the recovery prospects, because of the spread of the virus, and also the fact that the vaccination rate is not picking up as fast, we do think that there is a possibility of a sluggish economic recovery, which when we looked at some of the other credits which come in the same, say, rating category of triple B, in the case of Philippines, the recovery is a little bit slower than, say, what we're currently expecting for, say, Indonesia or Malaysia. So those are some of the things. And also because the contraction in GDP has been much more than what we saw in some other countries, our concerns about the potential scarring effect of the pandemic is higher in the case of Philippines than the other sovereigns. And if you even look at unemployment rates, for example, they have come down. The latest number is about 7.7%, but it's still much higher than what it was in the pre-pandemic levels. So these are some of the factors that can explain why we have looked at this credit a bit differently. However, I do have to mention that last year we did take some negative rating actions. For example, we downgraded Malaysia's rating last year. And in the case of the Philippines, we did an outlook revision from positive to stable. So that's where we are, vis-a-vis Philippines and the other credits in the region.
Now, on the country's herd immunity target, you did say that it's ambitious. What do you mean by this exactly? Do you mean that it is at least unrealistic? And what sort of progress do you want to see?
So, yes, when we looked at the rate of vaccination so far, and we looked at the target that the authorities plan to achieve, which is 70% by the end of this year, they're just under about 3% of the population is fully vaccinated as of today. So, looking at the pace of vaccination and the logistics around rolling out an effective vaccination program, we do think the target is quite ambitious. As such, we don't have a specific target in mind, but when we look at, say, how other countries in the region are performing, Philippines is one of the lowest when it comes to number of people who have been vaccinated so far. Vietnam is a bit lower than that. But say when we look at Malaysia or Indonesia, Thailand, these are countries where maybe the rate is a little bit more. So the point here is for us, when we look at growth projections, um, if the vaccination rollout is slow or there are difficulties, then it poses a downside risk to, the economy opening up fast and growth recovering. So that's why we are highlighting this as one of the drivers or one of the concerns that we have, and that affects our growth projections as well.
Now, also you have, Sagarika, you've suggested, at least Fitch has suggested more stimulus is needed to jumpstart the economy. Where specifically does it need to go?
So, in terms of our view, I don't think we are saying that the authorities need to spend more or stimulus is required. I think what we're saying is that we'll monitor how the fiscal consolidation and growth, the growth recovery, how these two move together. And so we'll be monitoring that, because that's going to be important for our outlook on the fiscals. And in terms of a stimulus, we don't take a view on where the stimulus should go. I think the way we would judge it is, if we find that it has a positive, say, multiplier effect on the economy, then it can help in the medium to long term. However, the balance between keeping the fiscals in check and at the same time growing, and at the same time the economy growing, that is what we will be assessing as we move forward. So I think that's where we are. We're going to monitor this because it will be a key factor in the development of the fiscal trajectory going out.
Again, thank you very much, at least for those insights. Sagarika Chandra, Associate Director of Fitch Ratings Asia Pacific Sovereign Team. Again, Sagarika Chandra, straight from Hong Kong. Thank you.
Thank you.
Here are other headlines we're keeping our eyes on. Retail prices of general goods in the capital region grew to its fastest pace in over 2 years in May. Data from the Philippine Statistics Authority show the general retail price index in Metro Manila rose at an annual rate of 2.1% in May. This is the index's fastest rate since the 2.7% year-on-year growth in April of 2019. The PSA attributes the uptick in May to double-digit annual growth in mineral fuels, lubricants, and related materials. Economists note elevated global prices and a weaker peso may offset slowing inflation in the coming months. Now, an additional 1 million Sinovac doses arrived in the country today. This pushes the total vaccine doses the country received to more than 21 million doses. With more supply coming in, the private sector is expected to accommodate more people for the vaccination drive, including some of their employees' dependents. Presidential Advisor for Entrepreneurship, Joey Concepcion, says with around 10 to 20% of private company workers already inoculated through LGUs, firms now have more room to extend their vaccination programs. Vaccination under the private sector is expected to boost the country's COVID-19 immunization efforts. The palace says daily vaccinations have reached at least 375,000 doses. And those are the biggest stories this trading day, July 14, 2021. Catch Business World live again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jes Delos Santos. We are One News. Mask on, wash hands, and stay safe, Philippines.